Tonight we decided we would have a little bit of a founders versus funders debate to discuss some of these core issues that are facing every founder in the Valley. And so I'm excited to get to welcome our panelists up here. So if you guys would come on up, we've got Andy McLoughlin from Uncork Capital, Manan Mehta from Unshackled Ventures, Tiffany Luck from GGV Capital, Holly Liu, founder of Kabam and a partner from Y Combinator, Matt Pierce, the co-founder and CEO of Trusted Health, Larissa Maranhao Rocha, the first employee at Brex, Oona Rokyta, the co-founder and CEO of Lance, and me, Josh Constine, the editor-at-large for TechCrunch. And if you don't know me, I've been in the Valley about 10 years, 8 years writing for TechCrunch, written about over 4,000 articles about a wide range of early-stage startups, late-stage social networks. Maybe you saw my 4,000-word piece about Facebook's crypto today. But I'm mostly fascinated with telling the first stories about new companies, because I think that's where there's so much room to define the narrative for these startups to find themselves. And I'm excited to have this panel help with everyone to find themselves tonight. Would you mind if vacate? Yes, thank you. I'm in the spot. This is my chair, sir. All right. First lesson, you just got to speak up and take what you need in Silicon Valley. But I wanted to kick it off by saying, one of the biggest questions we get all the time, journalists, investors, founders, is this question of the bubble, of whether companies are overvalued, whether we're going to see some big correction where startups will suddenly be downsized in their valuation, where it'll become much harder to raise and companies should be stockpiling capital. And so I'd love to hear perspectives from our panelists on, are we in one of those bubbles right now? When will that burst? And what can you do to take advantage of that, either on the investor or the founder side?
I've got a mic, so I guess I will start. I think the one thing that's true about the bubble is if you say it's going to burst, you will inevitably at some point be proven true. I think the question is just when. We've seen, I think that actually valuations based on the data we've seen have actually been pretty static at seed over the last couple of years. And I do feel like as investors, we have to be part of the solution, not part of the problem, and therefore pushing back on valuations for reasons that aren't just about allowing us to spend less to buy more, but helping the founders understand that actually this is good for them and good for the ecosystem as a whole is something that I think we should all be doing.
It's super easy to get in over your head and say, I'll stretch my valuation this round, but then if anything goes wrong in those next few months or year, suddenly attaining an even higher valuation is going to be an incredible struggle, and you're at a deep risk of a down round, which can trigger that downward death spiral for a startup.
And it's not just the down round as well. When you think about the employees you're bringing on board, their stock options are going to strike at a price which is based on the valuation that you determine when you fund them. So you can effectively be, and I'm going to swear here, you can really fuck your employees by going for a price which is too high too early, because when it comes to actually exercising those options, they have to pay a huge amount of cash.
Yeah, I would just say from our perspective, it's a big fat question mark. Like for the last 10 years, we've, seen up and to the right, and we have no idea when there could be a downturn. And for us, we looked at how much capital do we have in the bank, and if there were a downturn, what would the implications be for us? And so, when we entered 2019, that was something that we had to take into consideration and really take it into account for our fundraising, timing. And we decided sooner rather than later because we had the right product market fit. And if there was a downturn, we were at a point from a capital perspective where we would be in some trouble. So that was just our decision vector.
Yeah, I think it makes sense. I mean, if you just looked at the numbers, you could say, okay, multiples just keep going up. But when you dig in, it seems like there's kind of constantly a new norm and things just keep resetting. And part of that is you're seeing companies that are actually bigger, stronger, and going faster than ever. So I think the world has changed a bit too. So it's hard to think of valuation just based on a number or things that you read in the news, and really have to think of it in context about kind of everything changing in the ecosystem. And when what we talk to our portfolio companies about is when you think about going out and raising, not just comparing yourself to the number that you saw maybe a competitor or another company raise at, you really have to think about kind of everything in context and what makes sense for you in terms of the amount that you need right now. Give yourself a little safety to get to the next round and really effectively, like, do you have enough to keep the business running until you can raise the next round, hopefully at a stronger point, and keep going from there.
Two things that we always say at YC is, one, don't play the valuation game, and it's so easy right now because there's so much momentum that's going on, and people are ridiculously investing in like, oh my gosh, that's a hot company, let's go and chase, which is sadly probably not the best thing. And then the second thing is, you as founders should always be in control of the future destiny. You shouldn't look at a capital raise, and I know this is incredibly difficult, as a way to get you out. So before I was visiting partner at YC, I started a company, and we had our Series B term sheet signed. And the day that they were supposed to wire the money, Lehman Brothers and Bear Stearns dropped, and there was no money to be found. And we were an ad-supported business at the time. And as founders, for all of you in that room, it was one of the hardest fundraisers that we could have ever done. So macro trends, like putting on my founder hat, macro trends were incredibly something that impacted you that is not anything to do with your business. So if you can figure out how to cut costs, we even pivoted our company. We became $1 billion company, and we exited as Kabam. So and we became a mobile company, a mobile gaming company, which was just so different from an ad-supported fan communities thing. So I certainly think one of the biggest tricks in success, and actually what a ton of founders here as immigrants have, is this ability to probably hold two real stories in their head. One that's super successful and one that can just go to crap. Especially people that have immigrated over here. It's just you live in such dire circumstances of trying to figure out how to survive most of the time. So being able to pull that, I think, is incredibly helpful as a founder.
Yeah, when you're talking about that valuation game, you always hear about companies that, they want to increase their valuation because then their stock is worth more, right? And that's good. But I think a lot of founders don't realize that the results are pretty binary. You mostly either win big or you just lose. And you should probably take all the help you can get along the way, because even owning a smaller percentage of something wins is a lot better than owning all of something that loses. So I wanted to ask a little bit more about where you do your raising, because a lot of these companies from Founders Embassy, they're all from abroad, and they're coming here to do their raising, and then a lot of them are wondering, should I stick around and experience this sky-high burn rate with all of the extreme talent and real estate costs, or should I go back home? And do you have to come here to do your raising? So I'd love to hear, do startups have to come to Silicon Valley to raise? And what do you think about this growing trend of the mullet, where you have part of your business, you have the business in the front and the party in the back, or they say you have your biz dev team, your team that focuses on raising, maybe your executives here in Silicon Valley, but then you have your engineering team, customer support, marketing, sales, the fun people over somewhere else.
So as somebody with a mullet, no, I actually think that having been part of a VC ecosystem and a startup ecosystem in multiple different places, San Francisco and the Valley is a great centrifuge, right? It's a great centrifuge for learning at an accelerated pace, for talking to a lot of people. There's certainly a concentration of funds as well. But stay mindful of who your audience for your product and your platform is, because that truly does dictate who will actually understand what it is that you're trying to do and will be the best match for your startup. So I think that it's incredibly useful that all of you are here, pitching here, and having all those conversations. But in order for you to execute in the way that you envision the company and to truly get the best partners for the path forward, I think stay grounded in those people that are going to understand what it is that you're doing best.
100% agree with the point on... Is that on? 100% agree with the point on understanding what your audience is. And here sometimes it's easier given the concentration. And one thing that we learned about fundraising here is we came in and we're a couple of kids from Brazil trying to make it in Silicon Valley, and we thought that it was this land of opportunity where everyone makes it, but we learned that it's a place that is very addicted to its own brands. And getting, embracing these brands, being Y Combinator or Stanford or investors that, open those doors, co-founders or team members that worked during a scaling phase of a very successful company, all of these help bringing that credibility to open the doors in the Valley.
Yeah, I think when having the benefit of investing only in immigrant-founded teams, I'll say there's two different parts to the question in my eyes. It's number one on capital raising, number two on hiring. I think there's something really noticeably valuable about raising capital in Silicon Valley. It's not because there's a lot of money, it's because it's risk-tolerant money. And when you have about even the bubble conversation, it really comes down to a supply and demand question. You only get a bubble when you have more capital than the number of companies that should be funded. And so valuations go up. And the same thing happens when you're trying to raise money in its baseline, right? And so the reason why a lot of founders do better here is because there's more risk-tolerant money. One of the best things I heard from one of my Swiss founders was, the farther west you go in the world, people go from saying, but what about this, to saying, and what about that? So the investor mindset shifts the farther west you go in the world. They're more of a dreamer with you, and they will be more tolerant of your journey, which could be really hard. The second part is around talent. Candidly, most of my teams have developers or team members abroad. I think that's an unfair advantage, especially if you can access things like R&D credits in Canada or access credits in Australia. There's benefits to having your dev team working 24/7, but at the same time, you need your core founding team probably in the same place. So it's a balancing act, and I think it should be recognized that as a company scales and changes the phase of their journey, that these questions start to actually have different answers. What I'm referring to is kind of the early stages when you don't have a lot of money, where you can try to find capital and talent in different places.
Well, the one thing I'd say on that, just as a kind of a counter argument, although I agree with you, and we love investing in teams that have kind of foreign-based, like other founders, they have their R&D elsewhere, is that it's much, much harder to find a soft landing for them. If you have a high-quality technical team in Silicon Valley, if the business isn't working, you can land them somewhere. But I do believe that we should be in the business of upside, not downside protection. But even so, when you're looking at an investment, you're like, okay, could we find a great home for this group of people somewhere if it doesn't just work out?
How do you guys think about that question of how much is too much, or how long can we stay bootstrapped, or how long can we stretch our existing capital versus the problems that come when you either take too much or too little?
Were we in too much of agreement for you before? Trying to get a little more disagreement?
Yes.
I one person's opinion, think that overfunding is very dangerous for a lot of reasons, and it's easy to get into that situation because there's so much capital, and a lot of people, we've seen rounds just get a little bit bigger and bigger, and a company goes out trying to raise 1 to 2, and then all of a sudden someone's like, we'll give you 10, and next thing you know, that's actually 20, and then a few weeks later it's more. And so I think that it's an easy place to find yourself in. And I think two things to consider. One really is just you're theoretically, it's a very long journey. And so you always want to be in a position where you can get to the next phase of that journey in a way that's least dilutive to you. And so you want to have the right partners. So you want to raise money, get investors around the table that can help you get to the next journey. But doing so to get you to a place of strength for the next piece. I also think that only taking what you need right now kind of forces you and the team to be scrappy. So we've seen one of our portfolio companies, actually, Ann and I were talking about it, a company called Slice out of New York. Alir is a third-generation pizza, and it's an operating system for pizzerias. And he actually bootstrapped the company for a very long time until he was like, okay, there's something really here, something really special, and now we want to take external capital to get it to the next level. And so I think it's a little bit of what kind of company do you want to build, and really just planning for that future with keeping that in mind while not letting the external factors, such as tons of capital, kind of get in the way of that.
I think the simplest thing to do is know what you're raising for and then think about relationships. So having been on kind of both sides of the table, having done due diligence at a VC and helping with PR and marketing there, as well as now having a startup, I think, one, know what you're raising for. Just, it's going to change for sure. But know what your roadmap is, what you're raising for, and then add a little bit of buffer, right? Because things go sideways, you change your path a bit, but don't just go for the extreme amounts from partners that don't know what they're getting into. I mean, we were offered millions of dollars at this point from real estate developers, right, that wanted to get into the startup game, and we immediately said no because it was way more than we needed, and also for a significant portion of the company, which would have shot both of us in the foot, right? So be clear about what you're raising for, and then also the relationship. Be thoughtful about who you're partnering with, why you're partnering with them, whether they'll actually be of value to you, right? And I'm sure we'll get to that in a minute, but that's really significant. And don't screw anyone over, right? Because that's not helpful to you in your future ventures if this one doesn't succeed. And they remember that, right? Either a startup or an investor. And then just adding to Tiffany's point, I think that it's just really useful to stay as scrappy as you can, because you guys all experience this, get comfortable in that space. It does light more of a fire under your ass, and you'll end up with more leverage, frankly, when you're coming to that investment table at the end of the day.
Oh, I will say this, absolutely as a founder who went through the Great Recession in 2008, I really wish we would have raised more money before going into it. It was like a death knell. And so I will say for our company, there was a little bit of a mindset of survival mindset once the momentum became a lot bigger, was to be able to raise when you could. And the funny thing about fundraising is I do think that there are markets, when you look at it's almost like surfing. You got to make sure that the waves are happening and that they're happening in your industry, because that's not anything you can change. And then the only thing you could change is whether or not you could catch that wave. So if there are waves that are happening. So you certainly, I feel like as a founder, have to be able to hold all these realities in your head of, okay, like I mean, this might be not kosher to say, but I really wish we would have raised a larger, like much more, and we wouldn't have been as in such a need for it or dependent on it. But it did force us to become cash flow positive and change our business in a very different way. And now I see a ton of companies come through, and I'm like, oh my goodness, like raising at the value. It's like that Silicon Valley episode where he's like, oh my gosh, I could have raised at a lower valuation and I didn't have to increase. Because every time you raise at a certain valuation, your next one has to be double or triple that, right? So you have to be super mindful, and you have to do the next raise usually in 12 to 18 months. So it's almost like skipping grades, right? Like if you raise a huge series, like a $10 million seed round, which is crazy, but that's like what it's getting to, right? Yeah, it's happening. Like, then you just have to think in 12 to 18 months, you not only do you have to find product market fit, but you have to be at Series B metrics. So it's super dangerous. So you have to be absolutely like disciplined as well in the momentum market.
The Slice example is an interesting one, because I think they just raised $300 million from SoftBank. So like
everyone loves pizza.
What's that?
Everyone loves pizza.
I mean, that's an interesting dynamic. From my perspective, I think Josh was spot on. Like, what we had to do was realize, one, capital is a weapon and it's your lifeblood. And so you have to raise as much capital as you can, but understand what is your threshold from a dilution perspective. And like, to Josh's point, for us, what we've seen is you either win big or you lose, and we'd much rather be a part of something that goes big and wins, and typically capital is a pretty critical part in that. And so we tended to err on the side of, hey, take a little bit more of a dilution hit and raise more capital. We're first-time founders, but that's what we looked at. And I mean, circling back all the way to the very first question, if there's a downturn, what we found is typically market share is gained in a downturn, and if capital is a weapon for us, that's something that we took into consideration. So,
one thing I'd say though is just not to confuse raising how much you can with how much you need, because the two are very different. And investors are kind of lemming-like. And if we see that like a bunch of people we know are piling into a deal, we'll be like, well, shit, we don't need to do our diligence because this person over here, they're really fucking smart and they're putting money in, so I'm just going to come in behind them. But what that means, though, is that you just ended up with this like bloated cap table. You've got too much money in, you become sloppy and flabby, and it's bad. The second thing is that not every company needs the same amount of capital. There are businesses that can monetize very quickly. They've been businesses that can monetize within 6 months of being formed. But there are businesses, for whatever reason, you need to prime the pump, you need to make a big technology investment where they need 2 or 3 years worth of runway before they can even have something in market. And that's why what we have to look at is like, okay, a business has raised $5 million before they go and raise a Series A. Is that correct? Is that the correct amount, or have they raised like 3 times too much?
Would you say you first figure out how much capital you need or what valuation you raise at? Because I mean, they're tied together, but like that, for us, that's what we were toggling on, right? And like, it was dependent, and then it became a dilution question, what we were ultimately willing to take a hit on.
So can I make a funny comment I just heard from a founder that we ended up backing? She was told by a very prolific AngelList employee and very active investor that you raise 1 at 5 or 2 at 10, regardless of the business being the exact same.
Yep.
How does that make sense? I mean, that's playing backwards math. The business stage is pre-incorporation, by the way. So is the input how much you want to raise and then you output your valuation? I don't know. I find that to be a very interesting thought process and one that I have a lot of opinions on. But I think the most important thing is that there's a truism that I really love, and I heard it on Twitter, is revenue has no board seat. Just build a product that people want to buy. And I think to your point earlier, customer traction helps answer a lot of these questions. And investors are in a business of deploying capital and finding how they can leverage their information arbitrage to get equity in what would hopefully be a fund returner. But let us do our job as investors, which is get in a catfight over getting into your company because your company has revenue, right? And so that's what I would advise every founder here. And again, I think it's really powerful with the immigrant community where most of you, if you're an immigrant in your home country, would never start a business if you couldn't get paid for it in the first 3 months. You would never do it. Bring that same work ethic here and watch how fast you survive and succeed. That's the problem with Silicon Valley, is that we forgot that it was built on the backs of really successful tech companies with customer revenue.
To that point, one thing I see that's a massive mistake, that when companies get too much funding, what they do is they just throw it at trying to find product market fit, usually by hiring. And until you know what you're doing, having more people in the room often just makes it more difficult to get anything actually done. Whereas if you have like a small team and then you can pivot, you're agile. Yeah, you might not have as many ideas in the room, but at least you can settle on something more agilely. And then once you know what you're doing, pour the money into good hiring to actually get that stuff done. But when people are like, oh, well, the product's not really working, the customers aren't really there, maybe if we hire a bunch more salespeople, that'll help. It's like, no. The product is what's broken, not the sales process. And so I always really advise companies to not hire big, even if you do raise a bunch of funding, until you're sure of where you're going. So now I want to ask a little bit about this founder-investor relationship, which would be especially fun with everyone on stage. And so, first I'd love to hear from the founders, do you prefer when your investors are more hands-on, like erring on the side of being like annoying because they're constantly talking with you, or more hands-off to the point where you're like, are they still our investor? Do they give a shit about us?
I don't think about it as hands-on or hands-off. I think about it in terms of kind of the relationship and what I want to get out of somebody that's investing in us, besides money, right? And so the most critical things I put into 3 categories. 2 of them are network, right? One is network, frankly, for your next fundraising round, right? Which is obvious. 2 is advisors, because hopefully these are people that have been operators or have been in the industries that you're building into, and kind of have a different level view in terms of who can advise you functionally, or kind of have a 30,000-foot view in the different spaces that you're building into. And then the third is just pattern matching, right? I mean, you're at opposite ends of the table in terms of investors being amazing pattern matchers, right, in terms of industry. And you're basically trying to break patterns, right, by doing things differently, by finding different ways for people to pay you for your products or whatever it is. And so use that balance effectively, right? Be aware of what you're building and how you're trying to change, disrupt things, and all of that. But then respect and trust the person on the other side of the table and tap into them to get that information, right? And that's what I kind of task my investors with as homework assignments whenever we check in is, hey, can you put me in touch with this person? Or, who's amazing in the finance space that you really look to for forward thinking and stuff, which is harder to get to than you would think. So that's how I use my investors and keep them busy so that they're not asking me for stuff, frankly.
Yes, I love that.
Like that. Give your investors homework so they stop bugging you.
Yeah. Homework never ends. I feel like we have a lot of homework, and we should. Because I think one thing that's important, though, is actually having that conversation prior to, during the, when you're raising, right? So before you take an investor on, really say to them and say, here's what I'm looking for help with. And a good investor should ask, what can I help you with? And it's not just showing up at board meetings or, introing you to a couple of people, but really hold them accountable. Look, first set the standard. So I want customer intros, or I want a really great peer network of founders, or whatever it might be. And it can certainly change over time. But I think be very specific about what you're hoping to get from that investor, and then make sure that you choose investors that are committed, going to be there, and actually deliver for you on that. I think is really important and actually helps both of you a lot along the way, and you develop a great relationship. So I think that's the most important, in my opinion.
We really see it as a partnership, definitely. And as I mentioned before, we came here, we didn't know anyone, so we started coming to the one person we knew and saying, hey, can you introduce me to everyone you know? And getting to that next person, can you introduce me to everyone you know? And we spent, until today, a lot of time speaking with current investors and potential investors, like advisors. That's a great way to filter out the transactional VCs, as you would call, because if they will only speak with you when they're ready to sign a check, they probably won't talk to you after they do so. Mm-hmm. So that's a great way to see, and not only to test for that, but to build the trust in that you're coming in, let's say, every other week, sharing what you've been doing that has been great, what you've been doing that hasn't been so great, asking for their advice, and you're building the relationship where it feels like they already know you beyond that put together deck. And that's what you want to build as you choose who you want to work with. You want investors that will be there to help when you need and will trust you, not to be on top of you on your way every single day.
The one thing I'll just add to that, I think, let's be clear, being a founder is really fucking hard. It's the hardest job in this room here. And as an investor, I'm the last one, as a founder of a fund, I'm the last one to make money. My founder hopefully makes money first, then my investors, and then I do. So I have to really figure out how do I create amplification with my effort and my energy to make the founders across over there wildly successful. Right? That's the only way, at least at my stage. Later stage investors have other mechanisms they get to do, but we don't. And so I think there's also a truism around the earliest investors tend to sit next to you at a board meeting. The later investors sit across from you.
Arms crossed.
And there's.
I don't think that has to be the case.
It doesn't have to, but there's an element where over time, the amount of money they're putting in your company necessitates a much more of a financial framework than a founder-friendly framework. And so as a result, they're going to hold you accountable to your quarterly numbers, your shareholder value, and all those metrics, which is very different than what your early pre-seed, seed A investors will have to be able to offer you. And so I think it's really important that, investors recognize that they have to create an amplification in every one of their companies to create success for themselves. And the founder community is small, they'll talk. So if you don't do it, you shouldn't really be in business. And so I'm a firm believer that it's really important that VCs need to recognize that they're the last ones to get paid, they're the first one to dish out money.
I think the best piece of advice I've gotten is to own the relationship. So it's your company, own the board relationship, and mostly investors are type A personalities, and if you give them an open forum, they're going to take it in which direction that they feel is best. Nobody knows your company like you know your company, and so unless you manage that relationship and direct them and ask for help where you need it most, then you're going to be taken in a million different directions. And so like when we got a board member and we understood what he could uniquely provide to our organization, it was like, here are the times we're available. This is what we want. This is our financial model we want to run through. We don't know what the hell we're doing. So you could really add some value here. Like, let's meet at this time and let's go through these particular metrics because this is what our question marks. And so I think if you own the relationship, that's what an investor's looking for too. Like, they want to know where they can provide value to the company. And so it's on the founder's shoulders. Just as you manage an employee, you manage your investors.
Yeah, I mean, I've seen this kind of work really well and really badly. You know, prior to becoming a VC, I was founder of a business who raised like $85 million from a bunch of really great investors and some really terrible investors. And surprise, surprise, the really terrible investors were the ones who would send us stupid articles, who would make crap introductions, who would have like really bad advice. And what we didn't do...
Why don't you tell us which those investors are?
What about the share?
There was one about kind of putting adverts in like a British Airways magazine that went in planes. It was just like ludicrous. But what you realize is, people generally want to help. They want to be useful, and it's your job as founders to push back and say, "Hey, this isn't good. These aren't great introductions. This isn't a good use of my time." I think the truism is that startups generally, not always, but generally die of indigestion, not of starvation. And if investors keep pushing stuff down your throat, you're going to choke. And so you have to own that and say, hey, look, this just isn't working for me, stop it. And remember, you can always fire your investors from the board as well. It's painful, but you can push them out.
So for the final question I'd like to discuss, I want to hear a little bit about what is it that really convinces an investor to invest in a foreign startup? And I'd love to hear like what tips have worked for founders. Maybe you're investing from investors abroad if you're based here. And for investors, like what is it that really tells you, hey, I might not know this market perfectly, I might not be familiar with their home region, but I believe in the company.
So we're actually just in the process of closing a deal where the CEO, commercial team are based here, engineering is all in Uruguay. And other than having an awesome football team, soccer, sorry, I know nothing about Uruguay, but I've gotten to know the country over the last couple of months as we've been digging in. And what you realize is great technical universities, great talent there, super low cost of living, but they're serving the US market. And I'm not a consumer investor, so I can't, I don't think I have the necessary skills to look at someone and say, I believe you can build a consumer product in Uruguay. But I do believe that looking at this team, they can build a great product that can serve primarily today the North American market and the future the global market with the team that they can build there.
To us, showing that beyond product market fit, if you already have that, is showing investors that you have what we call team market fit. So why are you as founders and your team the very best in the world or in that market to build that particular product, right? And also the grit, showing that you're people who will go beyond the expected to really achieve the extraordinary. One quick anecdote, our first investor, someone who really wanted to get on board was McLoughlin. And that's co-founder of PayPal, would bring all the credibility, open a lot of doors. That's the first person we wanted to bring on board. And Enrique and Pedro tried to get introductions, tried to get his attention unsuccessfully. And then they found out that Max's company was hiring interns for the summer. And they went through the process knowing that the last round of interviews would be an interview with Max. And they took the process very seriously. They went through it. And on the very last round, they were in front of Max and said, hey, we have a confession. We're not here for a job, but we have an idea that I think you'll really like. And until today, he's makes all the difference for us.
Was he like, you wasted my time and my company's time, get the hell out?
Not at all. I think he's pretty happy with what his stock's worth now.
That's great. I love what you just said. I think it's what you call with people market fit. What we talk about in Unshackled is a people problem fit. So before the market, even the problem that you're solving, is it relevant to you? And I also wrote a piece about a year and a half ago called The Power of the Adversity Muscle. it was my view as a first-generation American on the immigrant population. Adversity muscle is often called in this country as American grit. I think it's borrowed from immigrants. And I think there's something about a founder being able to tell their story and embrace the hardship that they went through to get to that point, to be in front of you, that really resonates strongly with me. Because we end up, personally as a fund, 60% of my investments are pre-incorporation. So I'm really betting on people, no product, no revenue, no customers, right? And so for me to hear is a major decision-making point. And I really respect founders that can tell the story of how far they traveled to get to this point. And not everyone has that story. So if you don't have that story, there's something in your past that talks about just the struggle, the grit that you have that I think goes a long way. And so for us, because we're industry and vertically agnostic, we really look on the people side. And I think that people problem fit, along with the distance they've traveled, speaks very, very highly to our ultimate outcome.
Great. So to recap some of the incredible insights from our panel, are we in a bubble? Well, eventually the answer will always be yes. But in the meantime, you have to make sure not to play that valuation game, because you could end up screwing your employees. You risk that bad down round. You're at the mercy of macro trends. So make sure that you have enough money to weather it through the winter. And when you come to Silicon Valley, what you're going to find is that risk-tolerant capital. And they're going to give you that and rather than the but. And you want to find your local heroes in your home markets who understand your market as well, but you also have to understand there's these Silicon Valley brands, and you have to be able to navigate who has that signaling power to help you unlock the next door. And when you're talking about capital and overfunding versus underfunding, it's easy to get overfunded in this market where there's so much dumb capital being thrown around. Everyone wants to gamble on startups. But you need to know what you're raising for, and you don't want to get stuck dry in the winter. So make sure you have enough squirreled away. But also, don't raise so much that you end up hiring to try to solve the product market fit problem, and don't take some giant party round where there's no investor that's really going to be accountable for that money. But revenue is an incredible board member. They never ask you for anything. So if you can get that revenue first, you won't even have to worry about it. The investors will come to you. But when you're trying to think about that investor and founder relationship, you have to take charge. Like if you give them homework, if you give that investor homework, they're going to help you. And if you're assertive about what you need and you talk to them before you raise that money about what you're going to need, you'll find a lot better fit with them. And you really want to find those people who are willing to go the mile for you before they even put the money in, because that's obviously going to be a great signal that they're going to help no matter what down the line. But you also have to be lining up those relationships so you can raise that next round. And when you're talking about what actually convinces those investors, you want team market fit. And you don't necessarily need to know, an investor doesn't need to know the market perfectly if they believe in the team. You want to have that team market fit because it means that no matter what happens, you'll find some way to succeed. And if you can tell them that story of grit, if you can tell that superhero origin story, you'll show them that it doesn't matter how badly the chips are down, it doesn't matter if every startup around you fails, or even if you have to fire half of your employees, you're still going to grit your way through it and make it into a success. So thank you guys all for talking with us, and thank you for watching.